Welcome back to the Pro Ticker Podcast, your Friday morning edition, covering major financial magazine headlines, everyone. We've got a roller coaster week in global finance, soaring stock markets, political shakeups, and even Bitcoin hitting a record high. But are we getting a little too excited? Is there too much froth in the markets? And what does all this mean for you and your investments? To help us break it all down, we've got an expert with us today.
It's definitely been a wild ride this week, and yeah, there are definitely some warning signs flashing that we need to pay attention to.
So let's jump right in with the U.S. market. And Bloomberg's reporting the S&P 500 is up a massive 27% this year, best performance since 2019. AI advancements and, the prospect of Trump's America First policies seem to be driving this surge.
Yeah, the market seems to be really buying into the AI narrative right now. And there's definitely a sense that a Trump presidency could lead to some big wins for the domestic market. But before we all get too carried away, we should probably listen to what Michael Hartnett, a strategist at Bank of America, is saying. He's warning about froth building in U.S. stocks. And he even made this kind of crazy comparison. He compared Bitcoin's $2 trillion market cap, and that's according to CNBC, by the way, to the size of the world's 11th largest economy.
Wow, it's pretty mind-blowing when you think about it.
Well,
One digital currency rivaling the economic output of an entire nation. But okay, Bitcoin aside, what does this froth actually mean for the average investor who's just trying to, make sense of all of this?
well, think of it like this. You know when you pour a beer and you get that nice foamy head on top? Looks impressive, right? But it disappears pretty quickly. It's kind of what froth in the stock market is. It suggests that prices are getting ahead of themselves, rising faster than the actual value of the companies. Hartnett points out that the S&P 500's price-to-book ratio, which is basically a way of comparing a company's stock price to the real value of its assets. It's getting close to the levels we saw back in 2000 during the tech bubble. And, well, we all know how that ended.
Yeah, not a fond memory for a lot of people. And speaking of things that might be artificially inflating the market, MarketWatch is reporting a surge in stock buybacks this year, hitting a record $1.248 trillion. They're even calling it an early holiday present for shareholders. But how exactly do buybacks contribute to this froth we're talking about?
Okay, so when a company buys back its own shares, it reduces the number of shares that are available out there in the market. This can artificially boost their earnings per share, making the company look more profitable on paper, and that can drive up the stock price. The problem is this might just be a short-term tactic. It benefits shareholders in the short term, but it could actually hurt the company's long-term growth and innovation. It's like imagine a company choosing to buy back its stock instead of investing in research and development or expanding into new markets.
So instead of baking a bigger cake, they're just slicing up the same cake into smaller pieces to make it look like there's more to go around.
Yeah, that's a great way to put it. And it's interesting, even Warren Buffett, the Oracle of Omaha himself, he's being very cautious about buybacks at Berkshire Hathaway. So if he's hesitant, maybe we should be too.
Okay, so we've got this picture of the U.S. market, showing signs of maybe a little too much exuberance. But what about the global landscape? Things seem pretty turbulent out there. CNBC is reporting political turmoil in France and South Korea. They say currency markets are holding steady for now. But everyone seems to be anxiously awaiting the U.S. jobs report.
Yeah, that jobs report is going to be a big one.
So what makes this report so crucial?
Well, it's like a health checkup for the U.S. economy.
Yeah.
It gives us a snapshot of how strong the labor market is, and that has a huge impact on everything, from consumer spending to the Federal Reserve's decisions on interest rates. A strong jobs report could mean the economy is doing well, and the Fed might hold off on those rate cuts. But a weak report could signal trouble ahead. It might push the Fed to cut rates more aggressively. Right now, Bloomberg's reporting that markets are pricing in a 70% chance of a rate cut this month. So yeah, everyone's on the edge of their seats waiting for those numbers to come out.
And speaking of rate cuts, Bloomberg is also reporting that economists are predicting faster than expected cuts from the European Central Bank. They're forecasting a quarter-point reduction next week, and at every single meeting through June, bringing the deposit rate down to 2%. So what's prompting this rush to lower rates?
Well, the Eurozone is facing its own set of challenges right now. Weaker economic growth and stubbornly low inflation are the main culprits. And then you add in the political instability we're seeing in Germany and France. And the ongoing conflicts in Ukraine and the Middle East, it all adds up to a lot of economic uncertainty. So it's not really surprising that the ECB is feeling the pressure to step in and do something.
And of course, we can't forget about the Trump factor. His potential return to the White House has some people worried about renewed trade tariffs. And that could really throw a wrench into global growth. Bloomberg's even quoting some economists who believe the ECB is going to have to walk a tightrope here, trying to stimulate the economy without letting inflation get out of control.
It's a tough balancing act for sure. And the consequences of getting it wrong could be pretty significant.
Absolutely. So we've talked about the U.S., we've talked about Europe, but what about China? That economic powerhouse. Bloomberg's reporting that Wall Street banks are predicting some pretty big interest rate cuts in China, as much as 40 basis points, which would be the largest cut in a decade. So what's behind these predictions?
Well, China's facing a very different problem than the U.S. They're dealing with deflation.
Deflation.
Yeah, instead of prices going up, they're actually going down, which might sound good at first, but it can actually be a sign of a weakening economy. It can discourage people from spending and investing. And the Chinese government is definitely concerned about this trend. So they're likely to use interest rate cuts to try and stimulate economic activity. And then there's also the whole uncertainty around Trump's trade policies and how that might impact China's economy.
So it sounds like China's trying to navigate a pretty complex economic landscape. And to add to that complexity, Bloomberg is reporting that 10-year Chinese government bond yields have fallen below 2% for the first time. That suggests that investors are expecting interest rates to stay low for a while. So what does this mean for our listeners?
Well, this low-yield environment presents both opportunities and challenges. On the one hand, it means borrowing money is cheaper, which could encourage businesses to invest and expand, potentially leading to economic growth. But on the other hand, it makes it harder for investors who are looking for fixed income returns to find decent yields.
It's a mixed bag.
It is, and it's a classic example of how one economic indicator can have ripple effects across different sectors.
It sounds like China's trying to strike that balance
Yeah.
between stimulating growth and managing inflation. And they have to do it all while considering the unpredictable impact of potential changes in U.S. trade policy. It's definitely something to keep an eye on.
Absolutely. And it just highlights the fact that we live in an increasingly interconnected world. Events in one country can have ripple effects across the globe.
Well, we've covered a lot of ground already, from the highs of the U.S. stock market to the complexities of China's economic policies. But we've got plenty more to discuss, so stay with us.
It's fascinating, isn't it, how quickly things can change in the global financial landscape. One minute we're celebrating record highs, and the next we're analyzing potential risks and uncertainties.
Yeah, it's like riding a roller coaster. But the track is made of economic data and geopolitical events. Speaking of roller coasters, let's shift gears a bit and dive into some specific companies and industries that are making headlines this week. What caught your eye?
Well, Bloomberg had a really interesting piece about Donald Trump's decision to appoint David Sachs as his AI and crypto czar.
AI and crypto czar.
Yeah, it's a brand new position. And it really shows you how much importance the incoming administration is placing on these two,
Right.
rapidly evolving fields.
That's a pretty bold move.
Yeah.
So what's the thinking behind creating this role? And why choose David Sachs specifically?
It seems like Trump really wants to solidify America's leadership in both artificial intelligence and cryptocurrency. And Sachs, with his background as a venture capitalist, he's deeply embedded in Silicon Valley. So he's seen as a bridge between the tech world and the government, someone who understands both sides of the equation.
Yeah, his resume is pretty impressive. Bloomberg highlights his track record, COO of PayPal, founder of Yammer, which Microsoft acquired for $1.2 billion.
Right.
And now he's running his own venture capital firm, Craft Ventures. He's definitely not a newcomer to the world of tech and finance.
Exactly. And his role goes beyond just, promoting these technologies. He's also been tasked with safeguarding free speech online, which has become an incredibly complex and contentious issue, especially with social media platforms struggling with content moderation policies.
So he's basically been handed the keys to three of the most powerful and disruptive forces, shaping the world today: AI, crypto, and free speech in the digital age.
Yeah.
It's a lot of responsibility for one person.
Yeah. His decisions could have a ripple effect across businesses, investors, even the geopolitical landscape. This is definitely a story we'll be following closely.
Absolutely. Speaking of potential disruptions, the Wall Street Journal is reporting that German industrial production took another hit in October, signaling a continued struggle for this vital sector. They're pointing to energy production as the main culprit, with output plummeting almost 9%.
That's a worrying sign for sure, especially considering how important Germany's industrial sector is to the overall European economy. You combine this decline with potential job losses in the auto industry and the looming threat of trade tariffs from the incoming Trump administration, it paints a pretty bleak picture.
And it seems like this economic chill is spreading beyond Germany. The journal also mentions that a broader Eurozone economy is slowing down, prompting the European Central Bank to consider those interest rate cuts we discussed earlier. Looks like a tough winter ahead for Europe.
Yeah, it does. And the article points out that this slowdown isn't just a European phenomenon. It highlights the impact of Chinese competition in the car industry, along with the slowing economic growth in China itself. It's a reminder that even the most robust economies are vulnerable to global economic forces.
Absolutely. It underscores the need for diversification and adaptability. Now, for a bit of a brighter spot, CNBC is reporting that gold prices edged up slightly on Friday, even though they're still on track for their second consecutive weekly decline.
Gold has had a remarkable year, hitting a record high of 2,790.15 per ounce back in October, according to CNBC, that is. So this recent dip might just be investors taking some profits after such a strong run-up.
Kind of like saying, okay, gold, you've had your moment in the sun, time to cool off a bit.
Exactly. But remember, gold often acts as a safe haven during times of uncertainty. With all the political and economic turbulence we've been discussing, it wouldn't be surprising to see gold regain its upward momentum in the coming months.
It's a good reminder that even in a world that's increasingly dominated by digital assets, there's still a place for the old reliables.
Gold has been a store of value for centuries, and that's unlikely to change anytime soon. Now let's turn our attention to a company that's been generating a lot of buzz lately, Robinhood. Goldman Sachs just upgraded the online brokerage to a buy from neutral, setting a price target of $46 per share.
That's a pretty significant vote of confidence from Goldman. What's driving this optimism?
Well, Robinhood held its first ever investor day this week, and they outlined some pretty ambitious plans for growth. They're looking to expand beyond their core brokerage business, grow their crypto exchange, become the top active trading platform within the next 2 years, and even enter the wealth management sector.
Wow, it sounds like they're aiming to become a one-stop shop for all things finance.
Exactly. And Goldman seems to believe they can pull it off. Their analysis, as reported by CNBC, cites Robinhood's impressive asset and revenue growth, their strong operating leverage, and the potential for sustained profitability. They do acknowledge the challenges posed by the evolving retail trading landscape, but their overall outlook is positive.
It'll be interesting to see if Robinhood can live up to these expectations. They've had their fair share of both praise and criticism in the past.
They have. They were really instrumental in democratizing access to the financial markets, attracting a whole new generation of investors. But they've also faced some controversy, especially after that whole GameStop saga a few years ago.
Oh yeah, that was a wild ride. It'll be fascinating to see how they navigate the regulatory hurdles and the increasingly competitive landscape. But for now, at least, Goldman Sachs is betting on their success.
Indeed. Now, before we move on, there's one more headline I wanted to touch on. Bloomberg is reporting that Wall Street bond sellers are anticipating some pretty generous bonus rewards in 2024, after a bit of a slump in 2023.
Ah yes, the annual Wall Street bonus season. Always a topic that generates a lot of discussion, and maybe a little bit of envy from those of us outside the world of high finance.
Well, according to Bloomberg search firm Options Group is predicting that U.S. debt capital markets professionals will see a 23% increase in total pay compared to 2023. And compensation consultant Johnson Associates, Inc. is forecasting an even bigger jump, 25% to 35% for bond underwriters.
Wow, those are some significant raises.
Yeah.
So what's driving this surge in compensation? Did the bond market suddenly discover a money tree?
Not quite a money tree. But it seems like the investment-grade and high-yield corporate bond markets rebounded strongly in 2024 after a few down years. A strong economy combined with the belief that a Trump presidency will be favorable for deal-making suggests that bond issuance is likely to continue its upward trend.
So more deals mean more fees for the bankers, which translate into bigger bonuses.
It's the basic formula of Wall Street. And Bloomberg points out that it's not just bond bankers who are expecting bigger paychecks. Workers across the financial industry are likely to see pay increases, but bond bankers who generally earn less than their counterparts in other areas of finance are poised for some of the biggest gains.
Sounds like it's a good time to be a bond seller on Wall Street. But I imagine there's also a sense of caution, knowing that the markets can be unpredictable.
You're right. Michael Karp, CEO of Options Group, is quoted in the Bloomberg article, advising people to manage their expectations so they're not disappointed if things don't quite live up to the hype.
That's probably wise advice,
Yeah.
especially in a field as volatile as finance. What goes up can just as easily come down.
Very true. It's a constant reminder that we should all approach financial matters with a healthy dose of caution and realism.
Well said. All right, let's take a quick breather. Before we wrap up our deep dive into the remaining headlines, we've got more market insights, geopolitical analysis, and maybe even a few surprises in store, so stay with us.
You know, sometimes these financial stories can be more gripping than any fictional drama.
I know, right? It's the real-world implications, the human element behind the numbers. That's what makes it so captivating. These aren't just abstract data points. They represent the aspirations and anxieties of people across the globe.
Speaking of anxieties, Bloomberg has a report highlighting growing concerns about OPEC plus drug. The Organization of the Petroleum Exporting Countries and their allies. They've decided to further delay those planned oil production increases, pushing them back to April 2025.
OPEC Plus,
Huh.
always keeping us on our toes. This is the third time they've postponed those production hikes. They were initially slated for October 2024. So what's the reason behind this latest delay?
Well, Bloomberg cites a few factors at play here. The slowdown in global demand, particularly from China. Combined with rising oil output from countries outside of OPEC plus lessing, it's created a sense of caution, I think. They're also extending the full unwinding of those production cuts by a year, to the end of 2026.
So they're holding back on increasing supply even longer than anticipated. Are they worried about oil prices crashing?
It's a delicate balancing act, as always. OPEC Plus wants to maintain price stability, but they also don't want to lose market share to other producers. The article quotes some analysts who suggest that OPEC Plus is concerned about a potential oil glut forming next year. If they increase production too quickly, it's a global game of supply and demand, and OPEC Plus is trying to, orchestrate that delicate equilibrium.
It's like a high-stakes poker game, with billions of dollars in global energy security at stake. One wrong move could have some major repercussions.
That's a great analogy. And it's a game with real-world consequences for everyone. Consumers feeling it at the gas pump, businesses struggling with energy costs, governments grappling with inflation and energy independence.
It really highlights how interconnected we all are in this globalized world. From the price of everyday things to the stability of entire economies. It's all intertwined.
It is. It's a powerful reminder that we're all part of this much a larger, intricate system.
Well, on that note, I think we've reached the end of our deep dive into this week's whirlwind of financial headlines. We've journeyed from the peaks of AI optimism to the depths of China's deflationary woes, with a few pit stops to check in on oil prices, Wall Street bonuses, and everything in between.
It has been quite the adventure navigating the complexities of the global financial landscape. Hopefully our listeners feel a bit more informed, and maybe even a bit more empowered to make sense of it all.
Absolutely. Our goal is to equip you with the knowledge and insights you need to make informed decisions about your own financial journey. And who knows, maybe we've even sparked your curiosity to explore some of these topics further on your own.
Knowledge is power, as they say. And in the unpredictable world of finance, that power is more valuable than ever.
I couldn't agree more. A huge thank you to our expert for joining us today and sharing their insightful analysis. And to all of you listening, thank you for tuning into this deep dive. We'll see you all tomorrow morning with a fresh batch of headlines from the world of finance. Until then, stay curious, stay informed, and stay ahead of the curve.